Dear students, good evening again. Today we are starting the new series of the lectures that is related to the fundamentals of financial management. Here we will discuss all the chapters of the fundamentals of financial management one by one. So the first chapter that is related to basically the concept or the basic understanding of the fundamental management. So first we have to understand in the chapter number 1 that what is the financial management, why we need it, and which areas are covered in the financial management. As we know that the fundamentals of financial management, the basic thing, the two words are there. One is the finance and one is the management. So it's the management of the finance. Finance is what? That from where we are getting the money to run the business. Obviously, if it is a business, they need the money. So what is the source of the money they will get? It may be from the investors, means the shareholders or the owners, or they can get the loan, or it can be a combination of both. So it can be a short-term loan, long-term loan. Again, in the shares, it can be a preferred share or the common share. So all these things are important. So first of all, we have to see that what is the basic thing, how we judge that this company has a good financial management, this company is strong or not. The first thing that we have is what is the market price, the market price of the firm's stock. So this is the first thing, that how we judge that what are the different type of the shares are in the company and what is the value of that shares. So it is not only important for the current shareholders but also for the future. Means any prospect is there. Prospect means the person who is not an investor but he or she is planning to invest in the company. They also be thinking about what, that in which shares we have to consider. So they think about what is the earning per share of the company, what is the future earning per share of the company, then what is the timing of the earnings, what is the duration of the shares they are issued, and the risk of these earnings. So all these things are very important. And one more very important thing is what, that is the concept of the dividend policy. The dividend policy of the firm is very important, that how much dividend they give to the shareholders, means out of their total earning, how much they distribute to the shareholders. They also consider there are so many other factors in the market, like economy of the country, the overall economic condition of the globe, even the market situation. So all these things should be considered while deciding the investment. So this is the very first thing. The share price of the market is the very basic thing when we are considering the financial management. Now the next thing that we have is the concept of the agency theory. Agency theory means what? Normally the shareholders or the owners are different, but the management of the company is different. The second concept is the agency theory. Now agency theory relates to what? That the managers are the agents of what? Of the shareholders. So there are two basically parties in any company. It may be a small company, it may be a large company, even a publicly owned company, or even a small registered company is there. So there are two parties. The first one is the shareholders, or what we say the stockholders, or simply the owners. But they are not running the company, especially if it is a large company. The company is run by whom? By the agent, by the managers. So the agency theory says that the managers are the agents of what? Of the principals who are the shareholders. The shareholders can assure themselves that the managers will make shareholders' wealth maximizing decisions. This is the very basic thing, the very basic purpose of the financial management, the maximization of the shareholders' wealth. Now, the shareholders, obviously they have given all their money, all their investments to the manager, so the managers have to take care of it. So that is very important. Either they are taking proper care or not. They may be taking some extra benefit from that investment. They may be thinking that it's not our money, we can just invest it somewhere and there's a loss or profit. It is not our headache. So, but this is a very wrong thing or wrong concept is there. So what they have to do, the managers should consider that this money is from the shareholder, but they have to use it in such a way where there is a maximization of the wealth, the shareholders' wealth. Obviously, they have to make all the decisions where to invest, how much they have to invest, and in which areas they have to invest. So all these things should be considered by the management. And against that, what they will receive, they will get the incentive, but these incentives should be appropriate. Appropriate means that they cannot take, like for example, the company is earning like a 10% profit or the 10% margin, but they may be getting like a 20% or 30% as a profitability as an incentive. So this should be appropriate incentive. If the management is monitored, obviously they will take the proper decision, because if there is no monitoring of the management, they can make any decisions which may not be in the favor of the company or maybe in the favor of the shareholders. The next thing that we have is the concept that maximizing of the shareholders' wealth obviously is their main objective, but it doesn't mean that they should ignore the social responsibility. So social responsibility, what is called as the corporate social responsibility or CSR, that is very important. Means they should not consider only about the wealth, but also they should consider about the overall society. Means what is the effect of this product, what is the effect of this company, what is the effect of this business on the overall economy, overall social behaviors, even the pollutions, even the products are not hazardous for the any animal or any environment. So all these social responsibilities should be considered in mind while making the business decisions. The next thing that is very important is the corporate governance. The corporate governance is the system by which corporations are managed and controlled. It encompasses the relationship among the shareholders and board of directors and the senior management. The same concept that we have already discussed, the agency theory. The agency theory is that there is a shareholder who are not running the company, who are just the owners of the company. Then we have the owners, and then between them there is a board of director who is obviously a middleman. You can say in a way that they are representing the management, also they are representing the shareholders. So the board of directors should make the proper decisions, and the corporate governance is very important thing, because most of the time owners are not present in the meetings, in the board of director meeting or in the making decisions, but the overall directors are present there. So they should consider the overall rights of the shareholders who are not present. So this is very important thing. And the last thing that we have is the concept. In the finance, we have two main things which are important. One thing is that they have to maintain the accounting records, like an accountant or the chief financial officer is there, or maybe a treasurer is there. So there are two main things are there. First of all, the financial officer. So the financial officer who is taking care of all the company, and then the controller. So we have two other things are there, or two sections are there which are under the CFO. One thing is the maintaining of the financial record. They have to record the financial transaction, they have to prepare the financial statements as per the international accounting standards or as per the generally accepted accounting principles. And the other party, or what we say the other head of the management, is who is making decisions that from where we have to get the money, where we have to invest it, and how to maximize the shareholders' wealth. So these are the two basic things which are under the CFO, or what we say the chief financial officer. So we have two sections here. One is the trader and one is the controller. The controller responsibilities are the primary accounting, and the treasurer responsibility is to make the decisions that where to get the money, how much to get the money, and where to invest that money. So this is the basic thing. So overall, we have discussed today about the financial management, what are the roles, but we have to consider very basic thing. The financial management is related to the maximization of the shareholders' wealth, but keeping in view the social responsibility. And also they have to consider that there is no conflict of interest among the shareholders and the management. So there should be no conflict among the agents and the principal. And for this purpose, obviously the corporate governance is very important, and the role of the chief financial officer in the financial management is very important. In the next lectures, In the chapter number 2, we will consider the concept of time value of money and how it works and what are the main purposes or the applications of time value of money in the business and especially in the financial management. I hope you have understood the concept, but still, if you have any doubt, if you have any question, you can ask me in the comments section. Thank you very much.